If you guys have been watching the stock market, you'll see meme stocks are going off again. So in today's video, I'm going to teach you how to become
the meme investor.
We're going to be going over tips on how you can not lose money while investing in meme stocks, as well as talk about ways that you can recover some money if you do lose money on your meme stock investments. Since this is a Monday video, I'll be going over to my TFSA portfolio and I'll be showing you all the non-meme stocks that I have in that portfolio and just talking about it at the end of this video. So let's get right to it and talk about the first tip on how you can not lose money while investing in meme stocks. So the first thing that you should do is get yourself a tracker. Basically, there's a bunch of websites online that track the activity on Reddit to see how many people are talking about certain meme stocks out there. And if you start to see a lot more activity on meme stocks, then you can probably be sure that the price of these meme stocks are going to go up soon if they haven't done so already. However, you can also study some patterns on these meme stocks and how often they're mentioned on Reddit. And if you see the stock has gone up in terms of commenting for the past 3 or 5 days, then you probably can make some sort of reasonable prediction the price can't continue to go up anymore. And that's probably when you want to start selling your meme stocks to lock in those profits. The second tip I have for you guys is don't buy after the stock has run up for about 5 days or so. And this is a general rule of thumb, 5 days, because when I'm looking at the charts of these stocks, we can see that after around 5 days, these stocks generally are at the top of their peak and they drop back down. So there's no point chasing those big gains 5 days in or 6 days into the run up. I would rather wait for a pullback and maybe wait for the next run to start. If you see maybe 2 days of a huge run up as well as larger volume than previously, I would say that's probably the best time to get in to try to capture on that momentum. The third tip I have is to buy all your meme stocks in a cash account. Don't invest in a TFSA, don't invest in an RSP, because if you happen to lose money, then you can't tax write off these losses. However, if you're in a cash account, you can write these off during tax season next year and at least save yourself on some taxes. And that's how you get back some money even though you lost money on your meme stock investment. The fourth tip is to sell covered calls. So if you are in Questrade or TD, for example, you can buy 100 shares or multiples of 100 shares of these meme stocks, and then you can sell covered calls on these meme stocks and make some passive income. So for example, let's say Blackberry is trading at $15 today. You buy 100 shares for $1,500. Then you sell the calls maybe 2 or 3 weeks down the road for $20 strike price, and you can instantly pocket about $200. That way you've effectively lowered your cost basis on your Blackberry shares by about $2 per share from $15 to $13. And if you happen to have your Blackberry investment go all the way down the drain and it drops to $9 per share, at least your cost basis was lowered, unlike the noob who decided to buy in at $15 and have diamond hands. This is a way to protect your downside, earn some passive income on the side, and also join in on some meme fun. If your covered calls expire worthless and you're still holding the shares, then just hold onto the shares until the next meme rally, and you can sell more covered calls there, further lowering your cost basis. The final tip I have for you guys is don't tell your friends you're investing in meme stocks and get them to start investing because of this. Because not only will you be losing your own money, you'll probably be helping your friend lose their money, and you might lose a friend as well. And on top of that, you'll be losing them more than just the money that they lost there. You'll probably be losing them multi-millions of dollars. And the reason why you're losing them millions of dollars is because you might have scared them out of investing if they lost $2,000 from meme stocks. But instead, if you introduce them to investing as a way of long-term wealth creation, then they could have actually effectively earned millions of dollars by investing in the right stocks using the right strategy. So that's how you could be losing your friends millions of dollars as well as losing their friendship if you get them to start investing because of meme stocks. So those are 5 tips on how not to lose money when investing in meme stocks, and also recovering some money if you do lose money while investing in meme stocks. Now let's jump over to my portfolio and talk about stocks in there that are not meme stocks. I was talking with my neighbor this morning and she said that 95% of the stuff that you see on YouTube is not real. However, guys, what I'm showing you here today is real. This is my stock portfolio. There's nothing hidden from you guys, because if it wasn't real, I would probably have a positive percentage gain in my portfolio. So know here, whether it's rain or shine in my portfolio, I'll be showing you guys my losses or my gains. Currently, my portfolio is still down by 2.73% as of when I started this, and I think this is actually doing better versus last week where I was down maybe 4%. However, if we compare it to the TSX index, we can see that that has changed by about 5.56% to the upside. So my portfolio compared to the index, I'm down around 7.95%. Now, if we go to a heat map of the TSX, we can see that energy, even in the past 5 days, is on a tear. It's been up 5.61%, which is greater than all the other different sectors in the TSX. And healthcare is down by 5.91. So my well health stock is in the healthcare sector, and that sector is down fairly significantly. Now, if we change this to the 1st of January, we can see that again, energy is beating every other sector out there by almost 20%. So because I don't really have any stocks in the energy sector, just if we go over to my total portfolio, most of these stocks are in like finance and technology. I have some telecom, I have some commodities, consumer staples, but I don't have anything in the oil and gas industry. So for that reason, I think my portfolio is lagging behind the TSX because I don't have any exposure to oil and gas. But for me personally, my conviction is oil and gas is not going to fare well over the long term. And I'd rather not just buy into a company that's like an okay company but has mediocre long-term returns. I'd rather be buying into these companies that are good for the next 5 to 10 years. We know that oil and gas is being phased out just with all the environmental concerns, and it's very hard for me to wrap my head around these companies actually turning around and becoming green companies. And for that reason, I'm not investing in oil and gas right now. I'd rather stick to my long-term investments where I see more promise 3 to 5 years or 5 to 10 years down the road. If we jump over to my transactions and scroll all the way down, we can see that I deposited $200 of cash like I'm doing every single week on June 1st. And that same day, I bought 4 different stocks. I bought Stella Jones, Enghouse, Dollarama, and Power Corporation of Canada, each 1 share at their respective cost bases over here. The reason why I bought into Stella Jones, I explained last week. I think that lumber is still on the rise. It's still probably going to be fairly high for the next couple of years as homeowners settle into their homes and want to do renovations like fences and decks. So the demand for wood will continue to increase. Enghouse is on a fairly large dip right now compared to my cost basis. My cost basis for this portfolio is about $60 per share. So seeing it at $52.27, I couldn't help myself but buy another share. Enghouse is a company that continues to generate free cash flow, and they also pay a dividend. I also continue to buy or dollar cost average into Dollarama at $53.34, which is below my cost basis. If we look at Dollarama here, my cost per share is $55.99, and I'm continuing to bring that down every time I'm buying shares below the cost per share. Now, going over to Power Corporation of Canada, I'm actually averaging up on the stock. So buying it at close to $40 per share, and if we look at my cost basis, it's $35.21. So I'm buying these shares even though it's up by about $5 from my original cost basis. And the reason why I've explained in previous videos is the net asset value of Power Corporation of Canada is around $45 per share. So getting it for $40 per share is basically paying about like 80 cents or 90 cents on the dollar. On top of that, Power Corp Canada does pay a dividend, and unfortunately, I still haven't found a fix on how to pull dividends from Yahoo Finance, so I'll have to stay tuned for that. Then at the end of the week on Friday, I decided to buy 3 shares of the Bitcoin ETF at $6.71. And again, my thesis for Bitcoin right now is that we're midway through the bull market and we still have a bit more upside to go. I think that the final push for the bull run will probably come somewhere in the fall. So that's what I'm waiting for here and slowly averaging in. Right now, Bitcoin is not really mainstream media anymore. Meme stocks are. So I think that this is the best time for me to continue to build out my position in the Bitcoin ETF in anticipation that it's going to pop one more time. Obviously, this is high risk, and we can see that so far my percentage return for the Bitcoin ETF is the biggest loss in my portfolio. I'm down about 21.28%, which is unfortunate when you're looking at it. And here you can help me out by smashing the like button. But being down by 21% is pretty much expected if I'm investing in Bitcoin. Every time Bitcoin's on a bull run, there have been swings where it's pulled back by 30 or even 50%. I'm not too worried about this loss in my portfolio right now as it's only on paper. And I'm fairly confident, probably 80 to 90% confident that I will end up making some sort of gain on this Bitcoin ETF. After all, if we look at the charts, anyone who's invested in Bitcoin for 4 years or more has never lost money. Now, sorting my portfolio by market value, I tend to look at the stocks that are not doing as well compared to the rest and averaging into those that are a smaller position as well. So for this following week, I'll probably be adding a bit more to my Wellhealth Technologies as it's still down about 8.12%. I've been slightly hesitant to add a bit more just because I have a large position in my other portfolios. However, right now it's a fairly insignificant portion of this portfolio, making up around 4.34%. And it's down about 8%, so I think I'm going to be looking for it to drop closer to $7 or just under $7 before I add more into this position. The next stock I'm looking to buy probably is Stella Jones. It's still sitting at under my cost basis at $47.02, so I'm willing to purchase into this company as per my thesis last week. And the final stock that I'll probably be buying this week is Kinaxis. So Kinaxis is down by about 10%. I only have 2 shares in this company right now. So I think that I can take some of the cash that I have on the account, which is around $49. And I'm going to be using that plus the $200 I'm depositing to purchase 1 share of Kinaxis. And these shares are fairly expensive at $135 per share. So I can really only buy 1 each week if I want to buy a share of Kinaxis. Now moving on to some questions from last week's video. The first question comes from Leon Dye. Can you talk about DND and whether the management buyout to take the company private is likely to occur at $50.50 per share versus whether there will be a higher offer bidding war? So my personal opinion is I don't think there's going to be a higher offer or a bidding war for DND. And I think it's just the fact that it's a lesser known company, as well as right now the stock is, I would say, trading at a bit of a premium. I think that management, because they know what the company is worth, they're willing to put out the cash for it. However, an outside onlooker probably doesn't have the same information as they do, and will be looking at some of the financial statements and realizing that the company's total addressable market is not that huge and probably not worth around $3.4 billion. When I last checked, D&D's total addressable market is around $10 billion, so they have a bit more upside to go. However, the shares have already 5x'd in a matter of, I think, less than a year. They IPO'd last summer around July or so, and the company since then went from $7.50 to $50.50 per share. So in my honest opinion, I'm not really sure what the management is thinking in offering $50.50 per share. The company is paying a dividend and they are cash flow positive. So these are 2 good things. However, maybe management knows something that we don't as investors. So my personal opinion is $50.50 will probably be the highest price anyone's willing to pay, and that's management. So once the share price hits there, in my other account, I will be selling my shares of DND if that is the case. The second question comes from Jordan. I own VFV ETF. What would happen if Vanguard goes out of business? Will I lose all my money? So the short answer to this is no, you won't lose all your money because each unit of the ETF is actually backed by securities. So the VFV ETF owns all the S&P 500 companies at different percentages, obviously. So each share of VFV has a percentage of each of the 500 companies, which Vanguard actually holds in their holdings. So if Vanguard goes out of business, that's just because they had bad management. However, your ETF is backed by actual assets. And in that case, what's going to happen is Vanguard will sell those assets and give you back your money. Typically, we don't see too many ETF companies going bankrupt. And if Vanguard goes out of business, then I think the world has bigger problems. If you want more information or to read more in depth on what happens when an ETF company goes bankrupt, you can check out this website over here on Investopedia. I'll post the link down below. As always, if you guys enjoyed this video, leave a like down below as it really helps out this channel. If you guys have any questions on investing, I'd be happy to answer them in the comments as well as on next week's episode if they're interesting enough. I'll be throwing up a couple videos on the screen after this. You can click on them, check them out. If you're there, I'll see you there. If not, keep up the grind and have a great day.